In terms of the macro, I think we're in early stages of heading towards probably one of the biggest recessions of most people's lifetimes. This is global. But the key thing in the macro is I'm more worried, which is a lot of that means metal should do okay, metal and like copper and gold. But I'm more worried right now about the big picture macro, this way overdue reversion in the equity market that got so expensive in a zero interest rate world, and the facts have flipped. 5%, 5.5% Fed funds is bad for risk assets that got used to 0%.
Bloomberg senior commodity strategist Mike McGlone believes the possibility of the United States economy going into a recession is now much higher than it was a few months ago. According to the renowned commodities analyst, the chances of a global recession, a period of global economic slowdown or declining economic output, is now almost 100% certain. McGlone says there are already very obvious signs of recession in Europe and China, and within the next few months, it will spread to other major economies, including the United States. A recent poll which surveys U.S. CEOs on their forecast for business conditions for 2024 reveals that a majority of the 240 CEOs polled believe the risk of a recession in 2024 is very high. 9 out of 10 said they expect economic conditions in 2024 to either remain the same or be negative. 30% chose the former, and 58% the latter. There was also a significant decrease in their ratings for expected business conditions next year. In August, on a 10-point scale where 10 is excellent and 1 is poor, the CEOs assigned a 6.4 rating. That dropped to 6.1 in September and 5.8 in October. One of the participants, Jim Nelson, the president and CEO of Par Instrument Company, noted that a recession is inevitable in 2024 because interest rates and other factors are stacked too high for further economic expansion. However, Nelson is hoping for only a mild recession. Unlike Nelson, McGlone believes this could be much more than mild, plus it won't be limited to the United States. He believes it's going to be global. For some economies like the Chinese economy, McGlone says the downturn could be even worse and longer lasting than people expect. McGlone is predicting a significant decline in equities and bonds, but a better environment for metals like gold, silver, and copper. We will now bring you clips from McGlone's recent interview with Soar Financially. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on the notifications bell, and don't forget to drop your comments and observations in the comments section below. Thanks, and enjoy the video.
In terms of the macro, I think we're in early stages of heading towards probably one of the biggest recessions of most people's lifetimes. This is global. It's already the case in Europe. We already have negative PMIs and negative retail sales, and they're still tightening. They might be done. Pretty much the case in China, as much as you can believe all the data. But China also helped spark it by the unlimited friendship right before the war, and now their best customers are heading towards recession. The U.S., it's a matter of time. Our Bloomberg economics team thinks it's going to start by the end of the year. Yes, they've been early. I've been early at most of my calls, but everything's starting to tilt that way. And so I'll kind of give you the brief overview. I think what's happened in the last few weeks with crude oil, I think, peaked around $95 a barrel. That 30-year yield probably peaked around 5%. I think the stock market has probably peaked, and it's going to head down from a normal recession, and virtually all risk assets should head lower. And if I'm right about this, Bitcoin should be one of the leading risk assets. It wasn't a way up. It wasn't way down. I think gold's going to come out ahead, and everything else is probably going to suffer by the wayside, with the exception of probably U.S. Treasury long bonds. From a macroeconomics point, I think it's accelerating the tilt towards a global recession. And let's look at what's happened with copper since it's happened. Copper's broken down close to new lows in the year. It's been one of my key indicators this year. Industrial metals, U.S. Bloomberg industrial metals down about 15%. They're showing global recession. Copper at $3.57 a pound is breaking down towards new lows in the year. I think that's going to $3. But what the invasion did is it sparked more fears of now we have the second major hot war going on. We have a cold war going on, and it sparked fears of cutbacks of supply from Iran. So initially we had that bounce in crude oil, but as the time we speak, crude oil WTI at $82.50 per barrel is below the price it was before the invasion. So to me, that's indicative. I think crude oil is going to 40 for normal recession. And this invasion, this conflict is on the back of what's happening in Europe. And we're finding out that the pump in liquidity, the pump in commodities on the back of liquidity we got last year was somewhat historic and it's going to do what pumps and liquidity and pumps and commodities always do in history. They're their own worst cure. Crude oil is a wrecking ball. I think everything's going to head down and do kind of what natural gas did. U.S. natural gas peaked around 10 last year, and the bottom this year was 2. So to me, this is part of that global macro reset kicking in. And typically at this stage, you would expect significant amount of monetary easing to help prevent it. The only country that's really easing aggressively is China, because they know the issues, the risks, and they're just kind of ignore what they say, watch what they do. The U.S. is probably done tightening, yet we still have some tightening price in the system. The ECB is probably done tightening, but I think the biggest risk here now is the final shoe to drop is the U.S. stock market has to go down, or the Fed's not going to ease, or bond yields won't go lower, or the dollar won't go down. It's kind of a lose-lose for risk assets. And the key thing I'm watching is U.S. stock market indicators for that. And the key things also, and that's already pointed out, industrial metals has told me the stock market's going down. This pump in crude oil and pump in bond yields right before that invasion was in somewhat akin to 1987, right before the stock market crashed. Bond yields pumped and then dumped. And crude oil pumped in 2008, right before the big global financial crisis kicked in. So to me, this is all happening. The key question I ask myself, guys, what's going to stop it? Typically, it takes an elongated period after the first Federal Reserve ease for risk assets like the stock market to bottom, and that's not even started. And like I said, our Bloomberg economics model is for the U.S. recession to really start by the end of this year.
At the moment, all eyes are on China, the second largest economy in the world, which is constantly referred to as the locomotive of the global economy. China's property sector is in a deep crisis, which threatens the very fiber of the economy. According to Bloomberg estimates, the properties that would be defaulted on if the crisis completely unravels are worth about 12% of the country's GDP. China's debt to GDP ratio is also between 280 and 300%, according to certain publications, including Bloomberg. During his interview, McGlone predicts that as investors move away from risk assets towards hard assets, metals like gold, silver, and copper will get a lot more attention, which will quickly reflect in their prices. Let's get back to the interview.
But the key thing in the macro is I'm more worried, which is a lot of that means metals should do okay, metal and like copper and gold. But I'm more worried right now about the big picture macro, this way overdue reversion in the equity market that got so expensive in a zero interest rate world, and the facts have flipped. 5.5% Fed funds is bad for risk assets that got used to 0%. Our economics team thinks by year end, their model for 1 year kicked in over a year ago. But what's really changed is this massive fiscal stimulus in the US. Some people estimated around 3 trillion. You can see it in the budget deficit jumping up to around 8.6%. Just this year. That's never happened without a recession or a war. Never. I mean, of course, my data only goes back to around 1950. You know what happened during World War II. But that fiscal stimulus was offset by monetary restraint. That's a big problem. And there's a residual effect of the biggest pump in liquidity in history, bar none. I mean, our government, some others, wrote checks to people. Some of that money is still left over, and a lot of it's going fast. Now, we've estimated that the amount of money cash on hand from Bloomberg economics for people is declining rapidly. Bank credit is declining rapidly. Bank credit is actually negative. These are all signs of early recession. What you see every day on the tape about strikes. I mean, it's classic end of period cycle stuff. And it's not U.S., it's global. So this kind of thing is just early days, but it's also, it's trying to be specific with the historic aspects of what just happened. Paradigm shifts aren't that easy to identify. I've been early, I've been wrong, but I do expect the S&P 500 to go to about 3,000. Normal correction in a normal recession. I don't think it's going to be a normal recession because we're so way overdue for just kicking back. But it was the end of that period where the Fed put was always there to save you. So I went back to 1915. Every single time the S&P 500 went down on about 20% or more on a 12-month basis, always the Fed was there to cut rates and started cutting rates. There was only one example where they didn't. It was 1988 because we already had the stock market crash. So it was the base measure. This time it's different. The Fed is clearly pointed out this is time to cut that umbilical cord where the market's just dependent on them every time they cut rates. And my colleague Irie Jersey has been spot on with the Fed. He says the Fed put strike is much lower than it used to be. So that's what the market has to start learning. It's not there for them. And this is part of the reason I think we're going to be in that great reset. So where has that already started to happen? You can clearly see industrial metals down almost 15% this year, despite the S&P 500 up about 15%. Now, that's a Bloomberg Industrial Metals Index. Copper's leaking lower. I mentioned natural gas, the inverted curve, one of the best indicators. And then, of course, U.S. leading indicators have been negative all year. And that's been consistent for 100 years for U.S. recession.
According to certain sources, prices in the metals market will drop briefly after the recession hits next year. But as soon as investors realize this might be more than your typical economic decline, everyone is going to be seeking shelter in gold, silver, and other metals. The race towards safe haven assets will become even more frenzied when the Federal Reserve starts printing again and people realize they won't stop until the dollar becomes worthless. What are your thoughts on McGlone's assessment of the situation? Do you agree that are heading toward a moderate to severe global recession in 2024? Please drop your comments and observations in the comments section below. Also, ensure you smash the like button, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.